Good afternoon, everyone. In this session, we focus on the sources of long-term funds, or we can say financing. All right. So when we are looking at the financial needs of an organization, remember that we said an organization's principal finance decisions. If it's a profit-seeking entity, we have three main ones: financing, investments, and dividend decisions. Right. So today we are looking at the financing part of things. And most importantly, when we are looking at finance, we are looking at the cost of the finance is what is important, as well as capital structure, which we shall look at in the next session after this one. Right. Now, this specific session does not focus on capital structure, but it focuses on the sources of finance and the cost of those sources of finance. Right. Now, overall speaking, we know that when we are looking at finance, right, we go back to IFRS 9, IFRS 7, and IAS 32, right, which is financial instruments, right? At the end of the day, the categories of finance, we have got two main categories, which is debt and finance. So between debt and finance, there are various other forms of financing that we can talk about, right? But debt and equity are plus or minus, they are the final ones. We can say this is debt and this is equity. Okay, so debt is sometimes referred to as financial liabilities as per IFRS 9. Okay, whereas equity, we are looking at equity instruments as per IFRS 9 or IAS 32, because IAS 32 is the one that holds the definitions of these financial instruments. Okay, now we have share capital or equity shares, right? It's an example of equity finance, right? Share capital or equity or ordinary shares. Now, these ordinary shares can be offered through what we call an IPO or initial public offering. Now, an initial public offering is when an organization issues its shares to the public for the first time, and hence it's called initial public offering. Okay, there are costs associated with issuing shares, right? However, we are not looking at the accounting part of things, which you guys covered at the management level in F2, right? And for those and undergraduate studies as well, right? Now, in this section, we mostly focus on the cost of these sources of finance. We also have got preference shares. Preference share capital can either be categorized as equity or as debt, right? Depending with their structure and many other factors that may be considered, or it can be a combination of both. We also have got retained earnings, right? Retained earnings and other reserves, which are also part of equity, right? And then from a debt point of view, we've got term loans from financial institutions, from government, from many other institutions which can offer debt. Venture capital finance, right? We also have got asset securitization, right? We also have got what is known as rights issues. Rights issues are ordinary shares which are issued to the existing shareholders at a price that is slightly lower than the market capitalization of the shares or the market price of the shares. All right. We've got to understand that the sources of finance can actually be issued at a stock market, right? Or at what we know as an alternative investment market. An alternative investment market is a market, or is a stock exchange for smaller companies, those which cannot, it does not have a lot of legal requirements compared to the stock exchange. In the South African environment, we have the Johannesburg Stock Exchange. The most popular is the New York Stock Exchange and the London Stock Exchanges. All right. Okay. So with the alternative investment market, it's more straightforward in such a way that it does not require a lot of regulations, just like the main stock market. All right. Right. Another important thing that you need to know before we look at the capital structure, right? Now, the capital structure of an organization, right, is a particular combination of debt and equity used by an entity to finance its operations and growth strategies. Okay. Now, debt may be in form of loans, bonds, and other securities, which we have spoken about earlier on, right? And we have spoken about equity as well. Now, there is what we call the optimum capital structure for every organization, but it varies from organization to organization. We're going to look at the theory of capital structure later on, right? For you guys to understand what actually makes up or what makes an organization valuable. Now, the importance of the capital structure cannot be overemphasized, simply because from the sources of finance that the organization use, right? An organization can actually maximize its value, right? Can maximize its value based on its capital structure, right? By looking at the cost of these sources of finance, by looking at what types of sources of finance it uses, it also assists itself to actually leverage the organization to perform better than it normally would do. Okay, right. Now, another important aspect before we look at the in depth of the equity and the debt, the importance of the rights issues. The rights issues, you need to know that they will dilute the value of an organization, simply because the rights issues are issued at a price that is a bit lower than the market capitalization of the shares. And hence we calculate what is known as the theoretical X rights price, right? Theoretical X rights price, it's called theoretical simply because the share price may not change on the stock exchange, but due to the fact that because the share price is not only dependent on the rights issues, but it's dependent on the perception of the public of the entity's securities, on the entity's securities. So if people see our securities as valuable, they are willing to pay more for them. So it's a matter of demand and supply. But because the rights issues would have been issued right? We calculate what is known as a theoretical X. X, it means after rights. It means that after rights issues have been issued, price. Theoretical X rights price, meaning that we calculate this price theoretically to be the new price that the share has. And that's why now you see this definitely you are going to get in the exam, and therefore you need to actually listen very carefully. Capital structure will always be in the exam. Adjustments on capital structure, adjustment on the share price, you will always get in the exam. Okay, simply because it's the heart of finance. At the end of the day, what we want is the value for the firm. And therefore, we cannot overemphasize the importance of financing and capital structure. All the major decisions are dependent on the capital structure of the entity, as well as the weighted average cost of capital, which we are going to look at when we cover the theory of capital structure. Okay, now we spoke about the time value of money in our previous session, and we carried out a number of computations, right? What is important in this instance is the calculation, right? The calculation of the cost of these sources of finance, right? Now, I'm going to use the board now. Please listen very carefully, right? Now, another important thing that you need to understand is when we are calculating the weighted average cost of capital, which is central to every decision that the organization makes in terms of finance, right? We need the value of equity multiplied by the cost of equity over the value of equity plus the value of debt, which gives you the total value of the company, right? Plus the value of debt, right? Multiplied by the cost of debt. Normally, the cost of debt has to be after tax. So it's KD 1 minus T over the value of equity plus the value of debt. Now, you see that on this formula, we would have determined this using the time values of money, right? So what remains is the determination of the cost of equity and the cost of debt, right? Now, the cost of debt is the one that we will start with because it's easy, right? Now, the cost of debt always has to be after tax. And remember, interest is charged before tax. So it means that you are supposed to always discount for tax depending with the entity's tax rate. So KD is calculated as I multiplied by 1 minus T, where I is the interest rate. Say if it's 10% and the tax is 28%, it will be 0.28 from 1. It gives you 7.2% would be the cost after debt. So debt is always given pre-tax, and you need to subtract the tax component. Are we together? Right. Then the cost of equity, right? The cost of equity is determined by using either one of these two methods. Number one, you can use what is known as the Gordon's dividend growth model. or you can use the capital asset pricing model. Some say CAPM, right? Capital asset pricing model. Right. Now, I will explain these two, right? Now, if we want to calculate KE using Gordon's dividend growth model, we calculate it as D1 over PO plus G, where G stands for the growth rate, PO stands for the market price of the share, the current market price of the share, D1 stands for next year's dividend, which means if you are given the current year's dividend plus the growth, it means that your D1 will be D0 plus or multiplied by 1 plus G, something like that, right? It means that you will grow the current dividend, right, to make it the future next year's dividend, right? This is how you calculate the cost of the equity, right? And remember, cost of equity is always after tax, simply because dividend distribution is done after tax, right? And now you need to understand that this also assists you in the calculations of the other topics we looked in, of the other ratios we looked in the topic where we covered ratio analysis, part B of the first session, right? Simply because it may assist you to calculate earnings and all those kind of things, and dividends and all that, all right? So you need to work around your formulas to determine some of these things. But we shall look into these things practically as well. But I hope you are seeing the picture. Right. Now, the most confusing of the two is the capital asset pricing model. Right? The capital asset pricing model is calculated as KE is equal to RF plus B RM minus RF. Right? Now, I am going to explain the components that are in these formula, right? Now, in most instances, you may find a question speaks of the market risk premium. The market risk premium is the difference between RM and RF. That is the premium. Where RF is the risk-free rate. Now, the reason why we call it a risk-free rate is because it is associated with long-term government bonds. Every now and again, government may say to its people, we are issuing bonds because government needs money, right? And they give you those bonds at a particular rate of interest. So it is called a risk-free rate simply because government will always pay you back your money. So that's why it's called risk-free rate. Because if you invest in government bonds, you are guaranteed to get your money back. Unless if it's in Zimbabwe, perhaps, right? You may not get your money back from the government. But all things being equal, you will get your money back from the government, right? Now, RM is a market-specific rate of return. If you invest, say, in retail, there's a retail standard rate of return. Say, suppose if the risk-free rate is 5%, you might find out that if you invest in a retail company, right, the rate associated with that particular market is, say, 9%. It means that the market risk premium will be 4%, which is the difference between your 9 and your 5. Okay. Now, when we're looking at the aspect of risk, remember there's what is known as systematic risk, which is the risk that cannot be diversified by an organization, right? And then we have unsystematic risk. Unsystematic risk is an organization-specific risk which the organization can actually diversify. So the beta coefficient B, right, represents an entity's specific risk. So it is part of the entity's unsystematic risk. It shows the entity's unsystematic risk, or the entity's level of unsystematic risk. Okay, where if your beta is equal to 1, it means that the entity's risk is equal to the industry's risk, level of risk, right? But if the beta coefficient is less than 1, right? If it's less than 1, it means that the entity is less risky than the company or than the industry, right? But if it's greater than 1, it means that it's more risky. But remember, high risk, high risk, high return. So companies normally with high risks or with a higher beta coefficient would normally give you a higher return on your investment because there's a lot of turbulence on those companies' securities. Whereas if an organization's risk is less than 1, it means that it may not give you lucrative returns. So as an investor, you then need to decide whether you are aggressive in your investments, you are neutral, or you are risk averse in order for you to carry out any form of investments. All right. So this can be adjusted or altered by the entity's business risks. So it's a combination of the entity's business risks, right, and the entity's financial risk. Financial risk, which is associated with the entity's capital structure, right? So an organization can actually alter its beta coefficient by altering its capital structure. We are now going back to the importance of the capital structure. So the importance of the capital structure cannot be overemphasized. All right. So this is how you calculate the cost of equity and the cost of debt. And having those various sources of finance, we need to understand the capital structure of an organization does have a bearing on the entity's cost of equity, cost of debt, and eventually the weighted average cost of capital. Okay, so an organization can further finance itself through other means like sell and lease back, right? A sell and lease back occurs if an organization decides to sell its assets because it needs money, so it sells them for cash and leases them so that it can be a right of use asset. Okay. Right. Then you need to know that when we are looking at this, an organization also may need to consider whether to buy an asset, cash, or to lease that asset. Decisions may need to be made. And we may need to consider which source of finance is cheaper by calculating the costs of those sources of finance, whether it's debt or equity. We may need to calculate the costs of those sources of finance. All right. Now, let me give you an example where we look at how to determine the cost of a particular source of finance, right? Now, let's say we have a loan, right, of 5 million, which is payable annually, right, for 20 years, right? And it's at the interest rate is 9%, right? Tax is 28%, and it's repayable after the 20 years at par, which means at the nominal value, right? After 20 years. Now, this is where now we need to calculate this using both the knowledge that we gained from time value of money and the knowledge that we got from the determination of the cost of sources of finance and the cost of capital, right? Now, here we can say year zero, we are getting 5 million. 5M is being received, right? And from year 1 to year 19, right? An interest of 9%. So 9% of 5 million is 450,000. So 450K is being paid, right? But remember, there's the tax. There's the tax which we need to deduct, right? So the 28%, that's 126K, right? Which means we now have 5M and 324K is being payable from year 1 to year 19. Year 20, we still have that 324 plus the 5 million. So we get now 5,324,000, which would be paid, right? So what we now do is we look at the discount factors, right? Present value factors at maybe, let's say we are discounting at 5%, right? Here it would be 0. Here, if you go to the tables on year 19, right? You must get 12.085, right? And here you get 0.377, right? So here you still get 5 million, right? Then 324,000 times 12.085 gives you 3,915,540. Then 5,324,000 times 0.377 gives you 2,007,148, right? So it means that your NPV here, these are outflows, right? Your NPV is there, right? Plus 3,915,540, right? Will give you 922,688, right? However, this is when you are doing because what you want is to get the cost of this source of finance, right? So what you can do when using your calculators, right? You go to cash flows, right? Cash flow 0, it's 5 million, right? You are receiving that, right? That's enter. Then cash flow 1, right? That is, you're receiving it 19 times, right? And sorry, that is 3,915,540. That's an outflow. Enter. How many times? 19. Enter. Right. Then the last cash flow 2, is 2,007,148, which is an outflow as well. Enter. Right. And you are receiving that once. Enter, right? Then you can now compute internal rate of return. Compute, right? Then you get your internal rate of return as 7.83%. All right, so you can use your calculator by just entering the cash flows. It gives you the internal rate of return. Or you can do it this manual way, right? So in continuation of the manual way, we can also discount these at the rate of 10%, right? And then we interpolate to get our internal rate of return, which would give us 7.83% as the internal rate of return. So by doing this, we have calculated, right? We have calculated the cost of the debt, but this is before tax. So we now need to multiply by 1 minus 0.28 to get it to after tax cost, to the after tax cost. So 7.83 times 0.72, which gives us 5.64%. That would be the cost of this particular source of finance. All right. So the same type of computation is associated also with capital investment appraisal, right? Which I did not include it in your topics because simply we don't have it in the syllabus, but I'm sure we need to look at it because there are certain principles that we may need to see. So you may also put it in your list of topics that we're going to look at, maybe after we look at the theory of cost, or theory of capital structure. Okay, so I think this takes us to the end of our session because we have covered all the principles that are important before we may look at the other topics. Thank you.